Welcome students. So now we will move to the next part of learning, and that is the cost of capital. So cost of capital is very important concept as far as the project cash flows are concerned or discounting of the project cash flows are concerned. Because if you have the project cash flows which we learnt in the previous discussion or the discussion we had in the previous classes. So if you have the say cash flows available with you and you want to now discount the cash flows, right? You want to discount the cash flows. So when we see that say normally we use the formula that is the you call it as the CT, cash flow in a one particular period divided by 1 plus R, right? So if you want to discount this cash flow and you want to find out R, so what is this R, right? So this R is basically the cost of capital or maybe the weighted average cost of the capital, we call it as this is a weighted average cost of capital. So if this R is not available with us, right? If this R is not available with us, you cannot discount the cash flows. And if you cannot discount the cash flows, you cannot say know the worth of the project or that particular investment. And finally, the entire process will go haywire. So we will have to find out that what is the say R, value of the R in this particular process. And R is you call it as the cost of capital, R is the discount rate, or R maybe a weighted average cost of capital if the funds are coming from the multiple sources. If you do not have any fair idea about the cost of capital or maybe the discount factor, then it would be very difficult, almost impossible to discount the cash flows because there is nothing to be put in the denominator, and you will not be able to find out the present value of the cash inflows, especially which are coming to us or maybe say occurring in the project over a period of time over the subsequent foreseeable years. Though the cash outflow is in the present time, most of the cases, maybe we can say most of the cases it is in the present time, in the current time, so that doesn't need to be discounted. But to compare that cash outflow with the series of the cash inflows, you need to have the present value, and for that purpose you need the discount factor, and discount factor is basically the cost of capital. So you can understand now the importance of the cost of capital and the discount factor. So when we talked about the investment criteria, where we learnt about that calculating the NPV, IRR, or maybe the say non-discounted cash, this capital investment measures, or maybe the investment criteria. So we required certain things there. So we after that learnt about that how we can estimate the cash flows, because there the cash flows were given to us. So we don't need to work out the cash flows, but in the subsequent discussion we learnt about the estimation of the project cash flows. And now the another important requirement of the project evaluation, or you call it as the investment evaluation criteria or capital budgeting, is the discount factor, because there if you remember we were given the discount factor. Weighted average cost of capital was given to us. So we were simply taking that factor in the denominator and we were just discounting the cash flows. Or you can simply refer to the present value tables or future value tables, and you can take the say cost of capital or maybe the compounding rate or rate of interest, and then you can refer to the table against the say given percentage of the cost of the capital in the present value tables and for the given number of years, and you can easily find the multiplication factor or discount factor. So you can easily calculate the present value of the cash inflow, right? So that is given there, but it's not so easy. In the real life you have to calculate the cost of the capital and you have to know about it, that what is the cost of your capital. Maybe it's coming from internal sources or it is coming from external sources. You have to know the worth of your capital. Only then you would be able to understand whether the project is giving you the desired amount of the return or not, because you have to compare that return coming from that project with something, and that something is basically the required rate of return. So we normally talk about something that is the required rate of return and the expected rate of return, right? So RRR and ERR. So it means our required rate of return has to be minimum that's a minimum equal to the expected rate of return. But if the expected rate of return is lesser than the required rate of return, you are going to abandon the project because NPV would be negative. But if it is equal, NPV would be 0, and if it is more than the say expected rate of return is more than the required rate of return, certainly NPV would be positive, and in that case say the internal rate of return available, maybe you call it as the say expected rate of return. Internal rate of return available from that investment would be equal to or more than the required rate of return, and then we will go that yes, we can make the investment because we are getting either the zero NPV or the positive NPV, or maybe the internal rate of return is more than the required rate of return or equal to, at least equal to the required rate of return. So we'll go ahead with that. So this is the process of learning about. Maybe it's very important that we have to have the clear and fair idea about that how to calculate the cost of capital, because in the normal course capital is not coming from one source. To any project or to any investment venture, the capital is not coming from only one source, it is coming from multiple sources. It can come from the equity investment made by the promoters or by the entrepreneurs. It can come from the retained earnings if it's an existing firm and they are investing the part of the say reserves or the retained earnings into the new venture. It can come in the form of the preference capital, it can come in the form of the debt capital. So when multiple sources are there, you have to calculate the weighted average cost of capital. That would become finally our discount rate, RD, or not RD but R, the value of R. And for that purpose, the clarity about the cost of capital concept is very, very important. So normally when you define the cost of capital, so you can say that cost of capital of any investment or a project is the rate of return, the supplier of the capital or investor, right? Supplier of the capital, it may be the entrepreneur who is giving the equity, or it may be the financial institution who is giving the debt, or it may be the venture capitalist, or maybe the angel investor who is providing the funds to the project or to the business. So the rate of the return suppliers of the capital would expect to receive if the capital were invested elsewhere in an investment of the comparable risk. If the capital was invested elsewhere in an investment of a comparable risk. So it means first requirement is, say the common denominator is that the risk has to be comparable when you are going to miscalculate the opportunity cost of the capital, because this is opportunity cost of the capital. Cost of the capital basically the opportunity use of the capital, because if you are investing it into the project X, which is a present investment option for us, so you are not investing it into the project Y. So it's opportunity cost, right? So it means the cost of the rate of return, not cost of capital, but the rate of return which you expect as a investor from an investment option which is comparable to the other investment option. So if you want to make investment in the project X, so what is the rate of return available from the project X? That has to be compared from, if this investment had been made in the project Y, what return that project would have given to us. So that would be the cost of the capital. So it's basically the rate of return the supplier of the capital would expect, right? The supplier of the capital would expect to receive if the capital were invested in an investment of a comparable risk. So it means if you have the 10 avenues, say if you want to talk about the simple bank interest, so it means that you can say you can invest into any kind in any bank, maybe any nationalized bank or maybe in the private banks also. Largely the return is going to remain the same because the risk level is going to same. Private bank may give you a little more, means 0.5% of more interest, but the risk is also there in the private sector banks. So comparable risk exists there. If you move to the bond market, so again you have to say find out the bonds of the comparable risk. If you want to move to the equity market, again the risk you are going to take is that has to be maybe of the say comparable securities you want to invest your money in. In the real estate also, if you want to make investment in the assets, so the assets have to be of the comparable risk, because normally return goes with the risk. So if you higher the level of the risk, higher the level rate of return available from that investment. So the avenue of investment which you are selecting, right, which you are choosing. So if maybe the return which is giving to us, that avenue of investment, the return it is giving to us, if you compare it with the similar other avenue having the similar kind of the risk, so if the rate of return is same on both. So it means you can say that is the cost of your capital. So you are indifferent. You can invest in project X, you can invest in project Y, because they are of the comparable risks. So the rate of return also has to be same from both. So if you are going to take the certain amount of the risk, so rate of return from the projects with the equal risk must be almost comparable or must be equal. So it's basically we call it as a cost, but it is basically the rate of return which we expect from an investment when we are going to make. And if we are not making the investment in that particular project, if we make investment elsewhere, how much return I am going to have from that alternative investment. Same I would expect from the project X also, because both are of the comparable risk. So when you talk about the cost of capital, it reflects the expected return. This is number one. And second thing, it reflects the opportunity cost. These are the two important considerations, because you have multiple opportunities, right? When you're choosing one opportunity, so you are not choosing the other opportunities. But all the opportunities are of the comparable risk, and they are going to give you, or they should be giving you, the same expected return. So you have to focus upon the two important things. First thing, the cost of capital, because it is reflecting the expected return. So the return from all the opportunities must be comparable, because all the opportunities are having a same risk or same level of the risk, a comparable level of the risk. So the return should also be there. So you can call it as that the cost of capital is either the expected return from any investment or the opportunity cost. Either way you define it, it is correct. And finally, we have to have a return from that investment which we are expecting, because we are going to take a certain level of the risk by making investment in any venture. So the return also has to be as per the expectations. Important points to be borne in mind with regard to the cost of capital is there is a three type of the capital, right? There is a three type of the capital. And the three type of the capital when you talk about is, first is the equity capital, right, which is given to us by the owner of the firm or owner of the project or owners of the project. That comes from the pocket of the real owners. Then you have the preference capital, which is generated by way of the preference shares in the market. But the preference shareholders may not be the real owners of the company. It's a kind of the equity they are providing, kind of the capital they are providing, the preference capital they are providing, but they are not the real owners of the business. They are only investors in the business, and that too for a limited period of time. And the preference is in terms of maybe paying the dividend to them, that any year when we pay the dividend or the firm has a sufficient profits to pay the dividends, and if any dividend has to be paid, then first it will be paid to the preference shareholders. After that, it will be paid to the equity shareholders. So that preference is there. And for example, if the project has to be liquidated at any point of time, then after settling the claims of the external stakeholders, that is the lenders, the first preference over the residual amount is of the preference shareholders. So that kind of the preference is also there. And a third source is the debt capital, right? So we have to take into account, while calculating the cost of the capital, you have to take into account the three important sources. Equity capital, that goes without saying. Then the non-convertible or non-callable preference capital, means any preference share or any preference capital which cannot be called before its maturity time or redemption time, or cannot be converted into the equity capital. That capital is called as a true preference capital. And the third capital is a non-convertible or non-callable debt. Any debt which cannot be converted into equity shares, or which cannot be called, or which cannot be paid back by the project before the time or date of maturity, that is called as the non-convertible or the non-callable debt. So these are the three important sources we are going to talk about. So this is number one, this is number two, and this is going to be number three. This is the equity capital, preference capital, and debt capital, which we have to consider while calculating the cost of the capital. When you talk about the debt, it includes both long-term as well as the short-term debt, because it's the external source of funding, can be used for both the purposes, long-term purposes and short-term purposes. So it can be used for that purpose. So we will have to talk about that and take that into account. And non-interest bearing liabilities, for example, trade creditors, number one, or maybe the bills payable, or maybe the expense credits, they are not included in calculation of the weighted average cost of capital, because on the liability side of the balance sheet on the lower part, you have some current liabilities, right? But they are not interest bearing. Current liabilities are of two types. One is a borrowing from the banks or financial institutions. They are called as the short term borrowings or the short term debt. That comes here. We will include that because we are paying explicitly, we are paying interest on that. But as far as the non-interest bearing liabilities are concerned, they are also short term liabilities, maybe the sundry creditors or maybe the bills payable or maybe the expense credits. So, on these sources, they are also providing the capital to the business, funds to the business, but they are self-adjusting non-interest bearing say liabilities, short-term liabilities. So, they will not be included in calculating the cost of the capital, right? And why we calculate the cost of the capital, right? Why we calculate the cost of the capital? So, the rationale is that if the firm's rate of return on investment exceeds its COC, equity shareholders benefit. This is the rationale of calculating the cost of the capital, that if the firm's rate of return on investment, maybe because the minimum criteria that the rate of return available from the investment has to be equal to the cost of the capital, because maybe whatever you are expecting, if it is available, that much of the return is available, so you are able to recover the cost of your investment, so you are happy with that. So normally it should be equal, but if it is more than that, if it exceeds, for example, if it is written, if the rate of return expected from any investment exceeds the cost of capital, it's going to be a win-win situation for the all stakeholders, or maybe the shareholders, or maybe the, you call it as the preference equity, or maybe say, though the interest rate is fixed, but if the sufficient returns are available from that investment, lenders also feel secured many a times that their investment is fully secured, because the rate of return expected from the investment is more than the cost of the capital. So, it means the firm would be servicing our debt on time, and our principal payment would also be repaid back on the due date. So, in that case, normally the rule of thumb is that the rate of return should be equal to the cost of the capital, but if it is exceeding, it's a very good situation. It's a very good state of affairs for all the stakeholders. Maybe the investors, you can call it as both the equity investors or preference investors, or the external investors who are lenders, who are providing the funds by way of lending the money to the business. So, it's very good situation for all of them. So, these are the three important points. Means first thing is we have to include the equity capital, preference capital, and the external debt, both long and short term debt, and the non-interest bearing self-adjusting liabilities such as trade creditors, bills payable, and this liabilities will not be taken into account for calculating the weighted average cost of capital. And decision criteria is that rate of return should normally be equal to the cost of capital, but if it exceeds, it's very good situation, and all the fund providers or maybe the suppliers of the funds are safe, and they are getting the returns more than the cost of the capital they have. And finally, it's going to maximize the value of their investment. And that's the ultimate purpose also of any business, that the value of the shareholders, especially the owner, should be maximized. But if you're paying back everyone on time, that's debt providers and preference capital also, so they also feel benefited out of it. So this kind of the investments are really very good investments, preferable investments, and we always have to compare the cost of capital with the rate of return available from the such investments for the appropriate decision making. Now, we talk about that which cost of capital should be considered as the discount rate, or which we have to be satisfied with, which rate of return is important for us. So, there can be two kind of the entities. One is the already existing company who is going to have another project, who is going to set up another project, or it's only a standalone project which is coming into existence for the first time. If it is a project coming into existence for the first time, then the cost of capital of that project would be very appropriate and good for us, and that would be used as a weighted average cost of capital or as a discount factor for calculating the NPV or IRR. But in any case, for example, if the project is owned or being set up by the existing company, right? So, in that case, we will have two cost of capitals. First cost of capitals would be the company cost of capital, which is basically the rate of return expected by the existing capital provider. So, this is one rate of return available with us, which is expected by the existing capital providers to the company. And second one we have is the project cost of capital, which is a rate of return expected by the capital provider for a new project the company proposes to undertake. For a new project the company proposes to undertake. So, because we have to select one thing, means that's the purpose of knowing and learning about the cost of capital, that you have to select out of these two, one as a discount rate, right. So, whether you would be taking company's cost of capital as a discount rate, or you will be taking the project cost of capital as a discount factor or discount rate. So, we are advised here, or we can see if you go through the literature, so we can find out that a company cost of capital, which is a weighted average cost of capital, is the right discount rate for an investment, which is the carbon copy of the existing firm, right. So, which is the carbon copy of the existing firm. So, the cost of capital of the existing firm, or maybe the existing company, should be used as a discount factor or a discount rate, because project is also going to be of the comparable risk as the company's existing risk is, and we expect that the capital structure of the new project would be almost the same as compared to the existing capital structure of the company. So, because the risk profile and the capital structure of the new project is expected to be same as that of an existing firm, or the owner firm, or the firm who is the promoter firm who is going to set up this venture. So, I think we should use the company cost of capital, because that is more stable and well tested cost of capital, because companies into existence for the years in the market. So, their capital structure has also become stable. That is a tested return available, and cost of capital which we are calculating for the company, weighted average cost of capital we are calculating for the promoting company, that is more reliable, stable and suitable and sustainable discount factor. So, we would be going for using the company cost of capital and not the project cost of the capital if both are existing. But if only the project is existing, or it's going to be a standalone entity, entrepreneurs or the promoters are going to set up this venture for the first time, then as per the capital structure of this project, the discount rate has to be set up or has to be accepted, and the cash flows, both outflows and inflows, have to be discounted as per the project cost of capital. So, if both, then company cost of capital, but only if the project is a standalone, then the project cost of capital would be taken as the discount factor. Now, we talk about calculating the cost of capital of the individual sources. So, as I told you, we have three sources. One is the equity capital, preference capital and debt capital. So, calculating the cost of capital for the debt and preference capital is quite easy and not difficult, we can say. But yes, for calculating the cost of equity, it's really a challenging job. And you should have a sufficient fair background idea that what is the equity capital, how the cost of capital can be calculated, and what are the important ways and means to know the cost of the equity capital. So, let us know the process of calculating the cost of capital one by one. And in this case, when we want to calculate the cost of the capital, so in this case we can say that first of all, we are going to learn about is the cost of the debt, how to calculate the cost of the debt. So, for calculating the cost of the debt, you see you have to use this model, right. When you look at this model is P0 is equal to sigma into I divided by 1 plus RD power T plus F divided by 1 plus RD power N, right. So, in this case, P0 is basically the current price of the debenture or bond, right. Debenture or bond. Normally, we use the term debenture if it is by the private sector firms. Any bond which is issued in the market by the private sector firms, that is called as debenture. But if it is by the government entity or by the government agencies, if the project is being set up by the government agencies, we will call it as a bond. So, bond and debenture are all almost the same. These are the documents through which we raise the funds by borrowing the funds from the market. I is the annual interest payment. This is the I is the annual interest payment, and F is the maturity value, not period. F is the maturity value, and N is basically the number of years left for the maturity. Number of years left for the maturity. Now, what is RD? This is a $1 million question. What is RD? RD is basically that discount rate or the cost of the debt which we have to calculate with the help of this model. So, how to calculate the cost? Because P0 is also given to us. Current price of the debenture is known to us at which we are selling the debenture or bond in the market. Interest rate also we know that at what interest rate we are going to raise the funds from the market. Number of years also we know that for how many years we are going to issue those bonds or debentures in the market, and on the maturity value, on the maturity date, how much value we are going to repay back to the lenders, right? What RD means, looking at all these inputs, what is the interest rate is the cost of debt? Can you say that the interest we are paying, annual interest we are paying, is the cost of the debt? No, it's not the annual interest only. So the question is how to calculate this RD, which is going to say use as a discount factor kind of for the interest as well as the maturity value. So for that purpose, you have to calculate the cost of the RD, means the cost of the debt. So maybe for calculating the cost of the debt, you have two methods to calculate it. Either you calculate it by trial and error, right? So you put here, for example, 10%, and then you solve this equation, this side, the right hand side equation, and then try to see whether it becomes equal to P0 or not. So at what rate it becomes? The whole value becomes equal to the P0, because all other interest is also given to you to be put on the numerator. Maturity value is also given to you to be put in the numerator. Only RD is not given to you. So you have to use trial and error method. You can say, for example, use 10% and try to compare whether the right hand side value is equal to the left hand side value or not. If it is not, then go for 11% or 9% or whatever it is. Finally, you have to make it equal. Both the sides you have to make it equal. So you can use the trial and error method. But sometimes it's cumbersome, it's a lengthier method. So you can use the approximation method also. If you use the approximation method, so this method is going to be very, very helpful for us, where you are going to talk about the I plus F minus P0 divided by N, and the whole divided by 0.6 P0 plus 0.4, means 60% of the present price of the debenture and 40% of the maturity value. So 0.6 P0 plus 0.4 F. So we have to take this. So with the help of this approximation formula or this model, we can easily calculate the value of RD, the cost of the debt, right? So you have two ways to calculate the cost of the debt. You can use the trial and error method, or you can use the approximation method. And to be quick or to have a better decision, because the approximation method also gives you almost a comparable value. So for example, if you want to calculate the value in the real world, so you can learn with the help of this example, that for example, the face value of the debenture or bond is 1000 rupees, and the coupon rate is 12%, and the period of maturity is 4 years, and finally the current market price at which it is selling in the market is 1040 rupees. So the face value, a bond of the face, means the face value, whose face value is 1000 rupees, that is currently selling in the market or for the 1040 rupees, because of the stock market change, or bond market changes, not stock market, because of the bond market trading and say changes and exchanges. So current price is 1040. So by applying the approximation formula, the approximation method, you can easily calculate that RD on this particular bond, the cost of debt of this particular bond is the 10.7%. Because you are taking the I here as an interest 120, and then you are taking the face value 1000, you are taking the same current market price is the 1040. So face value is basically what is the face value if you want to take it? So this is going to be the F. F is basically the maturity value. A bond which is currently selling in the, trading in the market, you can say trading in the market for 1040 is actually the face value of that of that bond is 1000 rupees. So if you hold this bond till maturity, you will get 1000 rupees. But because of the bond market changes, it's trading more than its face value. So that's why it is 1040. And divided by 4 number of years, and 60% of the this current market price and 40% of the maturity value. If you use this formula, so you will find out that the cost of this bond, or the cost of the debt or investment on this bond, the rate of return available from this bond is basically 10.7%. So coupon rate is 12%. Coupon rate is 12%, but because the bond is selling at a the face value is 1000 rupees and it is selling a current market price is 1040. So because of that, the difference between the coupon rate and the say rate of return exists here, that is 10.7% against the coupon rate of 12%. But with the help of the approximation method, you can easily calculate the cost of the debt, and here we can say the cost of this debt to the company is basically 10.7%. Company is getting the funds at the 10.7%. So this way you can calculate the cost of the debt. Then similarly you can calculate the cost of the preference capital, because for other factors, means other factors remaining the same. When you talk about the preference capital, that is comparable to the debt capital basically, because almost all the features of the preference capital are comparable to the debt capital. Debt capital also comes for the fixed period of time, and the preference capital also comes in the form for the fixed period of time, right? And the return to be paid to the investors is also fixed, that is called as a preference dividend or the dividend on the preference share. So that is also remains prefixed, that percentage also remains prefixed. So like debt component, as in the debt the interest rate is prefixed, so the preference dividend is also prefixed. So tenure is also fixed, the face value is also fixed, and the say maturity period is also, redemption period is also fixed. So almost maybe in all aspects you can say the preference capital is comparable to the debt capital. So same approximation method we can use here for calculating the cost of the preference capital to the company. So in this case you can say the face value of the preference share is, that is 100 rupees, but the market price is 95 rupees, right? In the market, a preference share of the 100 rupees is trading in the market for 95 rupees, and dividend rate is 11%, and the redemption period or maturity period is 5 years. If you use this model here, so you can say that the approximate yield to the investors of the preference capital is going to be 12.37%. So it means the investor of the preference capital in this company is getting 12.37% of the return. So it means you can say that you can understand now that if the 12.37% as an investor, if you are satisfied with, then fine. If you are not satisfied with the 12.37%, you can look for the other avenue of investment. But the cost of preference capital is to the company also 12.37%, and approximate yield to the investor is also 12.37%. So a company which is paying a dividend of 11%. So finally, on the basis of the approximation method, 12.3% is the cost of the preference capital in this case. So you talk about the yield to the investor is also 12.37%, and the cost to the company also is the 12.37% of this preference capital. So means you can calculate the cost of the preference capital like the cost of the debt capital, because approximation method is also applicable in both the cases. And if you compare the features of both the sources, they are also comparable, because tenure is also fixed, the amount is also fixed, the dividend rate is also prefixed. So finally both have the face value and the market value. So you can use the approximation method and you can calculate what is the cost of the debt capital to the company and maybe the return to the investors, and what is the cost of the preference capital to the company and return in the form of the yield to the investors. So that can be calculated with the help of this approximation formula. So this is how simply we can calculate the cost of the debt and the cost of the preference capital. And now we will be learning about the cost of calculation of the cost of capital of the third important source, that is the cost of equity. And this is a very you can call it as you call it as a difficult process as compared to the first two. So we have to learn different aspects while calculating the cost of equity. So we have to learn different the factors we have to know about. We have to have the exhaustive information about those factors, and finally we will have to use certain models for calculating the cost of the equity. So the discussion on the cost of the equity we will be having in the next class. We will stop here for the moment, And so far we could discuss the basic fundamental requirements of calculating the cost of capital, why the cost of capital is important, and how to calculate the cost of debt and cost of the preference capital to the company, as well as the rate of return to the investors. And in the next class, we will talk about the cost of equity in detail, or calculation of the cost of equity in detail. Till then, thank you very much.